welcome back to another episode of the On the Ramp podcast.
Welcome back.
Hi, Leo.
Hi.
Hello. We're chewing the fat today.
Yeah, finance, chew the fat.
On finance. And before you turn off, I promise you, it's going to be interesting.
Give us at least 5 minutes.
Yeah, give us at least 5 minutes. So we're with Lee Schofield today, who's the founder of a company called One Funding. Hello, Lee.
Hi.
Thank you for travelling down from Bolton.
My pleasure.
Bolton, people may pick up on the accent.
Yeah, there's. I'll try not to say garlic bread and other associated puns with Bolton.
Well, thank you for joining us today. We've got a lot of questions to rattle through, so it's going to be hopefully quite a fast and furious episode. We're going to try and get as much information in as we can. We're not giving financial advice, Leo, just to make that clear. We will give people our opinions and how we've done things. And Lee, you're here to help us understand ways in which garage owners can benefit from one financing and then the various types of financing available to business owners, because I think it's one of those industries, isn't it, that's a little bit misunderstood.
Yeah, it feels a bit smoke and mirrors sometimes, doesn't it? I think people don't really trust. It's a bit like I guess like the whole used car salesman thing, isn't it, to a certain degree? That
yeah,
because there's been such talking about years ago with bad PR and press about people kind of getting stitched up basically, whatever. So it's
but even in your experience, in my experience, it's you get a bit of money over a period of time with repayment, but it comes with the world's longest contract, and you never feel like you truly fully understand it. And it's not always apples to apples, is it? There's reasons why some are a bit more expensive than others, and it's not always about the cheapest all the time. And
I also think that finance is articulated in various different ways depending on who's delivering it. And I think in our industry at the minute, that's the quality is probably the challenge. So again, for business owners, trying to give them some transparency of what's really crucial.
Yeah, that banging, by the way, is a mechanic downstairs. Yeah, don't worry. It's podcasts and guests and listeners are used to lots of irritating background noises
on the ramp.
Yeah, literally on the ramp.
Yeah.
So do you want to just give a very brief introduction as to who you are, why you're here, what your background is in this field?
Yeah, I've been in the asset finance industry for nearly 20 years. Accidentally fell into funding commercial workshop and garage and body shop equipment. I started on the phones engaging with suppliers traditionally, so I worked a lot of partnerships with equipment manufacturers. And then I sort of navigate my way through a business to director level and complete an MBO there. End of 2023, decided to leave that business and set up One Funding. So we've been going now 9 months with a real specialism and focus on the automotive industry, because it's what I know, the ups and downs and the challenges that those businesses have, but also the approach that's needed to give them clear and transparent guidance on next steps, whether that's with us and our product range, or sometimes it isn't and it's not the right thing. So yeah, I've got a real passion for the sector because there's some fantastic people in it.
And just to back up what you just said, we spoke a couple of times about finance, and you are true to your word. You have recommended us to use our bank in some cases as well. Okay, so just jump in at some of these questions, and Lee, I'm going to aim this one at you, mate. You ready?
I'm ready. Let's go.
And I know you've been doing some consultation, which is quite exciting. So you've had a few people take you up on that, and not just with the garages that you're consulting with, but from your experience and from your own experience, what do you think some of the biggest financial challenges are that independent garages are facing today?
I guess it depends where they are on their journey. One obviously is always just getting funding in the first place for some, if they're new, start out and on a growth journey. But I've found that quite a few people don't borrow, haven't borrowed. So because and they might have been in business for 10 plus years, and it's almost that thing that's been set in the mindset not to borrow money. And like we said before we started, if you don't need to and you got the cash, then you don't borrow. But I think some people, because they don't understand it at all, they probably don't know who to go, where to speak to, and then if an opportunity does arise and they do want to grow a business, I think sometimes people are kind of, I want to grow and do this, and it's like, well, how am I going to fund it? I don't know. And then they go and do the day-to-day running the business, and they kind of almost lose interest in that idea because they can't get past that first sort of hurdle.
And I guess that what would ultimately end up happening is they'd end up saving up the money. That decision might be delayed for a few years, or they just wait till the money's in the bank and then make that. They're really struggling with that downstairs, aren't they? That's very loud.
Yeah. Got the edges out.
I don't know what it is.
Wow.
It is the air chisel.
big job.
That's rather unfortunate.
You should ban that at this site. No air chisels.
No air chisels. Right, there may be a little edit here,
Yeah.
or we'll just carry on. So yeah, to your point, it's a case of a garage owner deciding that they've just not made that commitment, not made that decision, and they may delay acquiring that piece of equipment or that expansion or that investment, right?
Yeah.
Well, it comes down to the plan as well, doesn't it? So, and being involved with acquiring businesses and things, I think we have to pause, aren't we?
Wow. Quick little edit. The air chisel has stopped for now.
Yeah.
Leo, you were saying it's all about the
I
plan.
was talking about, having a plan, and with being involved in acquiring businesses recently, I think if you have got kind of cash in the business and you might be selling your business in 3 or 4 or 5 years, again, I'm just thinking off the top of my head here, but you're probably better keeping that cash within the business, because when you do sell, you'll be able to kind of get that cash out with better tax relief rather than using that cash to go and buy equipment. Does that make sense?
Yeah, so again, it comes down to the plan, doesn't it? So moving on to the next question then. How can garage owners avoid the common financial pitfalls that hold businesses back? And I think that we've kind of spoke about that slightly in the previous answer, in that if the industry is moving pretty quickly, it can require investment in training, equipment, etc. And if you have the mindset where you never want to borrow money and you don't have the money in the bank, what are you going to do at that point? Are you not going to invest? Are you just going to stand still?
Yeah, it comes down to the speed of what you want to achieve things at. If I think we've just expanded the body shop, which has probably cost a couple of £100,000, and that was for a body shop we'd only acquired a couple of years ago. To save that cash up to be able to do that could take 10 years, I guess.
It probably would have never happened, would it?
Yeah. So, but then some people are perfectly happy doing what they're doing, earning the money as they go along. So again, it comes down to that where you want to be in a certain length of time, and not a full 5-year business plan of what the whole, it's not like we're saying you need a 5-year cash flow balance sheet P&L plan, but at least an idea of kind of where you want to be and then how you work towards that.
And also the impact of the relevant obligations that you take on. That all fits into the plan. I think I said to you before that equipment and funding comes into 3 packages for me. Does that piece of equipment make money? And have I thought it through? How is it going to generate revenue for the business? Is it going to save me money somehow? Or is it a nice to have?
Yeah, it's that balance of thinking about it too much versus not thinking about it at all and just signing away, and then all of a sudden, like, shit, I've got a £5,000 or whatever monthly payment, and not thought about how quick. Because the other thing, we had this in the high Q site we just opened. Yes, we funded a lot of the equipment, but that delay between using the equipment and getting cash in the door. Yeah. So if it was, say, for example, it was all done by November, we didn't open until January, we've got at least 2 months there of payments, which is quite a lot, which you've got to consider that as well.
Yeah, and that, again, I know you mentioned it's not necessarily to have a full cash flow forecast, etc., but you really do have to be mindful, don't you?
Yeah, definitely.
If you're investing in a piece of equipment, what is the return on that?
Well, with asset finance, it's a fixed term obligation. So once that agreement starts, you're locked in, whether that's sort of 12 months to 5 years, really, is your sort of average term time. And once you're in, if you then decide that you want to settle early, again, that's probably one of the most frequently asked questions I get. Well, what about if I wanted to settle early? The very clear question is you have to pay all the remaining payments because the lender has allocated that money for that set period. And again, people don't realise that then when they ask for a settlement figure, for example, because...
Is that more of like a lease purchase rather than a hire purchase?
Both.
Right. Okay.
Both. It's all future rentals. And we were talking off camera before about the interest is front loaded. So again, just making sure that you're getting the right product, the right term. And sometimes that might be, you might supplement that finance agreement with a deposit to bring the payments more affordable. So,
are there many lenders? I know this is in the rental industry. Some do have like a initial payment holiday. So like the first 3 months you pay nothing. Is there many lenders that do that still now? Or?
No, I mean we do some of that sort of stuff. We do some seasonal payments, but that tends to be when we're working alongside a supplier or a manufacturer of equipment to be able to drive more engagement to that supplier or manufacturer. By putting those types of schemes in place. But the reality is that the stronger the business, the more established it is, the stronger the balance sheet, naturally then creates more financial options that are available. When you look at a brand new start business at one end and a business with a successful balance sheet, the options are available are quite minimal at this end.
Yeah, whereas
but still doable. We're doing brake testers and MOT bays now for brand new start garages because the story stacks up.
So say, for example, that we're going to touch on, someone wants to start their own business, and I remember when I first started, MOT bay was a thing that we didn't get straight away because it's the biggest expense, where you can kind of get enough money to pull a ramp together and you've probably already got your own toolbox with tools. So somebody wants to put a new MOT bay in on a brand new limited company, for example, what things are the lender looking at for that to be put in place?
It's a really good question. I mean, we've got applications that come in and we look at them, and it's always about the story. So new starts are probably something that and I'm quite passionate about because someone's got to start somewhere. It's very difficult when they've not put any thought into it. And forget the numbers, forget finances for a minute, but I've had people who say, I want to open a garage. Why? Because I just like cars. That doesn't really wash with underwriters and lenders. But we have had those that maybe have reached a senior position working for somebody else. They think they can go and do it themselves. They're a homeowner. They've got obviously standard stuff, clear searches, credit searches. But they've saved a bit of money over a period of time. They've got a bit of a war chest that they can go and start their own business with. The length of lease that they sign, they've shown some commitment. They've signed a 5-year lease. All those things are really good story. And the questions we ask are, what's that person do away from this business? What does their wife do? And I know these are the thing they're quite personal questions, but it stacks up to build what's that person like that's looking to borrow 30 grand, 40 grand, whatever it might be.
Is there an element where, I've had it in the past. So if you're starting out a new business, you want to borrow 35, 40 grand from MOT bay, you don't own your own house, so you're renting a house, you've got kind of like not really any savings because you pull it in to open the business. What's the chances then of kind of...
Well, the first place that a lender will look for is where is my out? Because workshop equipment is valuable to the business, but not necessarily so much to a lender. So they're out.
If they had to come and repossess the equipment,
Correct.
It's probably going to be worth what, sort of 30p in the pound, I guess, or something.
Correct.
Yeah.
So what they'll do is go, what is my other out? And a brand new start business with tenanted directors, they would look for a homeowner guarantor.
Right. Okay,
So someone with clear searches that mum, dad, relative, whatever that might be, to come and sign that contract.
I found this is one of the annoying things. I remember when I first started, I opened an account with Barclays, and it's always sort of, you need a business plan, and you spend ages doing this business plan, and you go to the bank, and it's still this computer says no.
Yep.
And I'd learned along the lines of like, don't waste your time with certain things, but you only learn that through trying and kind of getting kicked back. But because again, at that point, I didn't own a home or anything like that, or whatever, and it was basically no matter what you put on that paper,
Who still
the
getting no
mainstream
back.
bank, yeah.
Do you think that some lenders do look at the detail of a business plan?
Yeah, absolutely. Depends on the lend. That's the reality of it. The bigger the lend, the complexity of the transaction, the more detail that's required to get to the decision. We've got lenders that have got auto approval for the right business up to 100,000 on workshop equipment, as an example.
Yeah.
And it goes in, it gets auto approved, comes out the other side. And that's as easy as simplistically as the job can be.
Is there anything not this will help you, but one of the places we got MOT Bay from first was Snap-on, because they used their own money. When I found that out, obviously Snap-on in the industry, and that's where a business plan did help, and it was them that actually supported me, because I think it was only open like 18 months, and they did look at it. So lenders that are using their own book, as in their own money, is there more chance there of those type of lenders kind of looking at a case study rather than a computer?
Well, I think when you've got a manufacturer-owned finance company like Snap-on Finance, they've got security in their products. I think there's a bigger play. It's around brand as well. I've seen loads and loads of banks that have got Snap-on Finance coming out of it. I think going to lenders, your own bank, we sort of touched on it before, but speed of decision isn't there. The high street bank manager is now gone, so you do have to do a lot of things online. Having access to capital is easier now. Certainly the application process is easier with the likes of Funding Circle, iWalker. Some of these people have got a really big online presence. But then what happens then, because it's so easily accessible, so you finish your day at work, you go online and you apply for a facility. And so many businesses, not necessarily just in the garage world, are using loan products to buy capital equipment. Where actually asset finance is there to purchase equipment with, and is more competitive when you look at pricing and structure.
It's much more easier attainable. So if you've maxed out your cash loans and then you do need to buy assets, and then in 3 years you do need cash, you're going to struggle.
Yeah, and like I said, it goes back to trying to find the right partner to take you on that product journey. To get because going back to your original point, if you've got the cash, like fantastic, there's no problem in that. It's a great place to be.
And how well does that help if you've got, say you're using an asset lender and you've got something with them, and then 2 years later you go again? How much do they look at, well, we've been with that customer for 2 years, never had a problem with the payments? Does that help
massive,
weight it more so than balance sheet and things like that? So if your balance sheet maybe is still a little bit, I don't know, but you've got a good 2-year track record with that customer/lender.
Well, we try and keep our lending panel into sort of, certainly our asset lending panel into 3 clear silos. You've got your tier 1 lenders, and they want the better credit because they offer cheaper money. It's as simple as that. They want the better assets. They want new assets. Your tier 2 is more storybook. So is that person building a lifestyle garage where they work really hard and they take the money out and they have a fantastic life? That's great. It's all about affordability at that point. If you've got the bank statements, can they afford it? Are they an existing customer? Have they made the repayments? Then it's relatively straightforward. And then we've got the tier 3 in reality, which is your higher risk businesses. Some of those are established, some of those are new start businesses, which are seen as a higher risk. But starting to get a payment profile with a lender, and what I've done over the years when we've supported garages, they come in as a tier 3 customer. By the time they've left, they're a tier 1. So it's, again, as a partnership, you take them through that lending journey to hopefully over time get them to where the cheaper money is, because they're building a robust business.
And I know we're going on a sidetrack here, but it's still finance. Are there any lenders that you work with that will actually come out to a business to kind of look at it and help, touch it, see it? Or is that not really a thing anymore?
The lenders wouldn't do so much. Again, it's depending on the lend. We're doing a transaction at the minute that's 6 figures, and the lender will go out and see and touch the assets that are there. If you look at probably the average deal size for a garage is probably 50 grand, 60 grand maybe on average. The lender wouldn't, but that's where a broker it comes into their own. It's their responsibility to come out and understand the business, whether that's in person or over the phone or Teams or whatever that might be. But it's fundamentally the broker's role, and that's what the lenders rely on, is that does that broker know the customer? Do they know why they're buying that equipment? Do they know what the output is? And putting that.
So are you taking a bit of a risk in these decisions? I know you're not part of the financial commitment, but can you gain a bad reputation if you broker too many
100%,
negative deals?
So we just sort of be really clear. Our industry has grown massively over the past 3 years because it's been really easy to become a broker. So you could come from one industry, go on a short training course, and all of a sudden you can set your own limited company up as an asset finance broker. The challenge with that is as it's grown, the quality is diluted somewhat. And it was only up until October last year that you didn't have to disclose commission. So again, what was happening is the industry was driving what was right for the broker rather than what was right for the customer. Now, when we launched our business, we built commission disclosure into the business plan because, one, it's the right thing, it's the right way to go. Very much like the mortgage world, mortgage broking, insurance.
Yeah, it's been there for
If you deal with a mortgage broker, you know what he's earning.
Yeah.
But in our world, people were earning from the lender, which is how we get paid, but they were also charging customers fees as well. So there's all sorts going on. So October was a really positive change, certainly for business owners and the audience listening today, is that when you see that commission disclosure, the first thing that should be asked, like anything, is have I received the value for that amount of money for the service that I've received?
Yeah, that's the key, isn't it?
When it came out in October, the thing that I said to the people in our business was, it's about value creation, value delivery, and value retention. So how does a customer leave us, and what is a transaction in reality, but give them the feeling that they want to come back through the door again?
It's a relatively fickle transaction as well, isn't it? Because it's always been what's the cheapest, who says yes and what's the cheapest.
And when your market grows, I think I sound like grandfather time now, but when I started, there was like 400 brokers. I think there's like 2,500 now. So it's.
And has that have you noticed any has it caused any issues in the broker world that you've seen at all?
I think larger brokers have struggled more because
it's reliant on that level. So are then, sorry to interrupt, but are people reducing their commission that they're earning then?
Yes.
Right.
And it's only because in reality that if you were earning 7% before and you're now working for 2%, it's because you were never delivering the value anyway.
Mm-hmm.
You know,
I guess also it's that if you can charge that, then why not?
Yeah, but I've over my career, I've always sort of pride myself. Even when I was the sales guy out on the road and on customers coming back, I always thought that was a really good sign of delivering the right outcomes and the right level of service. So we're, our run rate at the minute, we have to be competitive. We understand that as a business, and brokers have to be because there's a lot of them. But we've just focused on that value creation piece, and I think that goes for any business. You know, how you look at the garage world, how many garages are out there that, I'm a consumer, how many garages because I drive into, I don't know the difference between a good one or a bad one, but when I've been and had that service,
you want to
that's
return.
That's the only place I'm going to go again.
Yeah, I guess that's like my mortgage advisor. I've used the same guy since my first house. I've been using him forever.
Yeah.
And it just feels good.
Yeah.
Like I trust him. Like get me the mortgage, and
He's created the value and he's delivered the value.
Yeah. To be fair, just carrying on with these. Oh, so just back to my original question before we move on to these questions. Then, so does the broker have influence over the lender?
Yes.
Yeah.
Yeah, they do. Volumes. I'll be really transparent with this stuff in terms of what goes on in a finance brokerage. But yes, they do with volumes. The more you do with somebody, a bit more flexibility.
So you can sort of say, come on,
maybe
get this one across the line.
Maybe different rate charts, relationships, but that's like any business. If you've got a good relationship with the people of influence, whether it's the underwriter or it's the girl, the girl or the guy who's paying the deal out.
So if there's a deal where it's a bit on assessing the business, it's kind of a bit like, well, we're not sure, but you can kind of say, look, I've been to see him. They've done this, done that. And I'd recommend they would listen to you.
Absolutely. Right. If you're a broker that's built up a strong reputation...
I'm going to say your reputation is key then, isn't it?
Massive. And also, I looked over my career and my bad debt, which you get judged on, my bad debt was less than 1%. I was, as a sales guy, I was doing 45 million a year in asset finance, relatively small transactions, but very few of them fell over because I also knew if it didn't feel right, it didn't smell right, I just didn't do it. Because I couldn't do it, I didn't want the aggravation of and the reputational damage. So reputation is
that's
massive.
interesting to know, and that's where again that value really comes in, then, doesn't it?
Well, when I launched this business, it was easy for me.
I mean, you're going to start schmoozing him now and trying to get him on side.
Yeah, it's business on the buy.
I'm on standby. But no, when I started this business, we got all the lending lines that we wanted based off the experience and the reputation that I built. It would have been easier for me to go and open a franchise. Right. Using somebody else's lenders, but I wanted to do it myself.
Right, loads of questions to get through. So one of them, Leo, I think this is really interesting actually, is making sure that you've got enough working capital, basically. So even though you've got the money in the bank to buy the thing you want to buy, is that going to affect working capital? And I think the knock-on effect of, let's say you do invest in a load of equipment, you do pay it cash straight out the bank, and then guess what happens on your next VAT bill? Or your next tax bill, you start and you've not forward planned. You don't have a cash flow forecast, which I would say, 99.9% of garages don't have a cash flow forecast, and that's absolutely fine. But if you don't consider working capital, Right, so just want to explain, what is working capital? How would you briefly describe?
Being able to pay your bills.
So it's the money you need in the bank.
I guess it depends, and everyone's going to have a different risk appetite, aren't they? I remember some people sort of say you should have enough in the bank. So if you had 3 months of non-trading, but the bigger you get, the less that's going to happen. And I remember watching a podcast recently of Brewdog owner. What was his name?
James.
Yeah, and he was saying that if you had £1 in the bank, you had too much, and then they went bankrupt 6 times, sort of thing. But then one day got to pay out a £50 million check in his bank. But I think that's a slightly different industry sector and things like that to running a garage.
Of course, it's all risk, isn't it? It's all how comfortable are you being
risky, exposed.
Yeah. COVID was a really good example of if you are exposed, you got.
Yeah.
And we've expanded really quickly over the last 10 years, and lived on that line of. We've got a month's working capital. Yeah. That's pretty much all we had. So of course, when you close your garage, you've got a month left before you go bust. And I remember speaking to garage owners who were like, "Oh, it's fine. I could carry on for 12 months without any issues." But I think it's a really good thought process in that if you are investing in equipment and you don't get a loan and you pay cash, and it does dip into your working capital, and then you struggle to then pay your bills, I feel like the added stress of having cash flow problems can, and I've said this before in a previous episode, is like there's no easier way to make bad decisions than when the decisions are purely just for cash.
Yeah.
So if you're, it's like almost
cash drives unprofitable decisions.
It really does. That's exactly right. And I feel like, again, it's like an unhidden thing with investing in equipment. If you introduce cash flow problems, and we've been there, it stresses you out at night. You might not make the right decision. You're not going to invest in the right thing. You might pull back on
a good example. I remember when we used to do car sales, and it was stock funded, and you'd have a car. I mean, I guess have you dealt with cars?
Yeah.
So you might have a car that you've bought for 10 grand, and you've got 8 grand kind of like tied up in it, basically.
Yeah.
So what I'm trying to say, you might have 2 grand equity in that car, and we need the cash. You'll sell that car at a loss to get your kind of grand back out. Whereas
you need to pay somebody else.
We need to settle the finance deal, or what. It needs to be settled because it comes with its days and things like that. So that can drive bad decisions, basically. But
when I got into finance in my early 20s, part of my sort of induction to the industry and way I used to approach it, which is still the same now, is why pay for your equipment? You sort of pay for it as it works for you, like you would a member of staff. You don't pay 5 years worth of wages up front. You pay them monthly.
That's a really good example, that is.
It literally has been, someone told it me 20 years ago, and I still stick with it now. It's still the same logic, and that's not to say don't pay cash for things by any stretch. It just depends how much cash you've got and how much you feel comfortable paying out.
Yeah, but I guess if a member of staff said you can pay me 30 grand up front for the year, or I want
exactly
40 across 12 months, you might think, okay.
Well, I came into a world of point of sale finance, and it was about Sky TV, the guy out on the street, saying do you want your children's package for another 30 quid a month or whatever. But if he said to you it's 400 quid for the year, you'd go. But everyone signs up for. So it's the same logic. Paying for things over time.
But then if you have, it's getting that balance. If you have got the cash, then you use your cash.
But there is the argument that
depends what your plan is. Again,
it's really it is all about a plan, isn't it? Because we've been in situations now. Again, spoke about this on other episodes, so I don't want to repeat myself. But we've got a plan, and it's a 1 year, 3 year, 5 year plan, and it's very easy to make a decision based on 1 year. But if you actually then consider the 3 and 5 year plan, that 1 year decision makes no sense.
Yeah, because you can't fulfill your
3 and 5. Yeah, and I think that again, if someone sat here listening to this and you are thinking about, getting finance or managing your cash flow, how can you manage it if you don't know what you want?
Correct. What's the end point?
What's the end point? Yeah.
I work with an FD, very talented FD of an automotive business, and their site fit out was £500,000. And to get he was very specific on the terms that he wanted, and we ended up doing 150 grand of a 600 grand investment. The rest he paid cash for, and it's fine. So there is a place at every.
Did he
level.
want to keep that? He wanted to keep that cash for something else, I assume.
Correct, and that's a well-established business, but there's a balance for me. And when I look at finance, and maybe some of the historic, viewpoint from the garage world about finance, I'd rather not borrow somebody else's money and all the rest of it. We're doing finance transactions at the minute for large corporates for relatively small amounts of money. Global businesses borrowing 11 grand over 3 years. So even the biggest businesses borrow money. And it doesn't have to be a huge sum of money either. It's just that it fits in with that structure.
You've been there, Leo, where that opportunities come up though. And if you don't have, let's say a big opportunities come up and you need a 30% deposit for whatever, if you've spent all that money on a bit of ADAS equipment or an MOT bay or a diagnostic machine at the cost of that opportunity, because then you're in a position where...
But I guess that's where the asset refinance comes in there as well, isn't it?
That's more expensive, isn't it? Is it more expensive?
It is, yeah. And I think the challenge you've got, just touching on refinance is very difficult for a garage.
Explain what asset refinance is.
So refinance is releasing equity from assets that are unencumbered. You own them. The challenge with the garage is that the majority of the assets that they own to a lender aren't worth a great deal.
Yeah.
That's me being completely open and transparent. So it's quite difficult to refinance. It's a lot easier in the haulage industry because you've got trucks and trailers and big bits of equipment. So getting to a point of being able to do a refinance for a business in the garage industry would be quite difficult and be quite expensive as well. Yeah. Because of fundamentally the assets.
I think in general, what much is the ROI of everything, isn't it? And thinking to the high Q site we just opened, if we didn't borrow, we wouldn't have been able to do that. And if it works, I'm not saying it will yet, but hopefully if the site pays off, what it could earn by end of year 1 or end of year 2 far outweighs that interest payment and that risk and things like that.
You look at something being in the red or in the black, if you spread it over a 5-year term with a minimal deposit, it's very simple to go, well, I'm in the black at month 4 or 5 rather than year 3 or 2 or whatever that might be.
On the Ramp is very proudly sponsored by Castrol and the race group from Certus Energy. Our own business, Lindley's Auto Centres, have been using Castrol products via the race group for at least 10 years. We get our own account manager. They help us set up the oil portfolios across the branches. And there's also someone to ring if we've got any technical queries or general queries. And having that relationship with the account manager, I think, is really important. We get dual branded workwear. So just like what I'm wearing now, we get this free for all members of staff. We get to use the Castrol brand across our entire business. So things like building signage, websites, general marketing, etc. And working with a globally recognized brand like Castrol, I believe, can really elevate your own brand. There's a rewards platform. So for every purchase, we accumulate points that we can redeem against certain items on this reward platform, which is pretty cool. And then there's an integration via our garage management software that allows us to actually see the exact oil product code that should be used in that vehicle, which in today's world and the complexities of oil is actually really helpful. So if you want to learn more about how Castrol can help elevate your business and you want to learn more about how the race group can help you, then please click on the link in the description below. Thank you. That comes back to how can garages manage that cash flow situation. I really like the idea of a piece of equipment. It might be £30,000 and it might cost £700 a month repayments. Split that £700 a month down to a daily figure. Even though it's only for 5 years, I still like to just play that game. It's worth £700 a month, like you're renting that piece of equipment, like you're paying a salary. What do you need to do in terms of profit off the back of that piece of equipment, and is it going to cover that?
But we do that as part of our what we call fact find. So when we're talking to a garage owner about why are they doing something, the why is really crucial. If I'm an MOT, well, why have you already got an MOT bay? Is this another lane that you're opening, whatever it might be, or is it new? Well, why are you buying an MOT bay now? Well, I've been sending my MOT referrals to another garage around the road.
Yeah.
And I've been referring 10 a week out. It's a real. That's how simple a business plan can be.
I was sat down with a garage owner, and it was at a business training event, and they just bought, I think it's like a DPF cleaning machine. One of the big ones. It was a big lump of kit. Quite expensive.
Yeah, they're not cheap, yeah.
Yeah, several £1,000s. And they'd given no consideration whatsoever into the business plan of that. They just know that they need, they get DPFs in, but they had no appreciation for how are they going to market it, what does the revenue look like, is there a business case for it, is there a business plan? And I don't know if they paid cash or they financed it. I imagine the type of person that probably just paid cash straight for it.
But again...
I think a lot of garage owners, their heart overrules their head. And I remember when we moved second premises, we bought all new Dura toolboxes, and it was a stupid thing to do. But
Did you finance them or pay for?
Finance them, but
it's difficult to calculate the ROI,
there's no business plan behind that. That's all. It's just I wanted it.
It goes back to that sort of pot too. That's equipment that's not going to make you or save you money. It's just a nice to have. It just looks good.
Yeah, stupid.
But again, I think there's a responsibility on the finance industry to ask those questions as well, and almost make people think a little bit.
Yeah.
Because the last thing we want is you lend money and then there's a problem 6 months, 12 months down the line. And one of the questions you asked me before was, what's the risk on us? The risk on a finance brokerage is that you commission what we earn from the lenders. You have to pay it back for the first 12 months.
If it fails?
Yeah, it's only in the first 12 months. But that's the risk.
Is it that long? Is it 12 months?
So there is an actual risk to you then?
Yeah. I mean, and I would rather us as a business walk away from certain deals or certain opportunities because, I built this business and the brand of this business is about business owners feeling like we're on the journey with them and we're part of it. So I would rather take that extra 15, 20 minutes talking to a business owner, make sure if you really thought about this. And whether that's a transaction at 10 grand or it's a transaction at £1 million or anything in between, I just think it's important. Just have you thought about this?
Yeah.
And again, we've touched on before, access to working capital facilities now is far easier. You can do it in your bedroom when you finish work, and next thing there's 50 grand going into your bank, and that's a gift and a curse.
Yeah.
Right. So, question then: a garage is considering investing in some new equipment. Listen to this. What are the options? How should they finance it? And should they consider leasing it or buying it or financing it?
Yeah, because to touch on the difference between lease, because there's finance lease, hire purchase, and then actual kind of lease.
Yeah,
hire,
I mean,
isn't there?
the two in my 20 years that I've sounded, there's two main products in reality. There's a hire purchase, which is growing in popularity over the past few years because of the annual investment allowance. You can write off the whole amount against your taxable profit.
Just go into that, just clear that up in detail. So,
okay, so the minute there's annual investment allowance limit of £1 million. So if your business, I try and keep it really simple, if you're spending less than £1 million on capital equipment, a hire purchase product is better for you because you can write that whole amount off against your taxable profit.
okay.
Yeah, so basically, if you buy an MOT bay for 30 grand, you get the whole 30 grand knocked off on hire purchase on
Correct.
that annual tax
But not
return.
on a finance lease.
Whereas on a lease, you only get the monthly payments across the 12 months on top of your tax. Yeah.
Well, a finance lease is fundamentally a rental. I'm paying per month for the usage of that equipment. So hire purchase has really sort of come on in the past few years, and we're doing more hire purchase than probably any other products. So again, you look at the customer journey and the key drivers. Is ownership really important? Yes, I want to own it. Right, well, the hire purchase is the product that you want then. The challenge then comes why people then go to a lease is because they go, well, I haven't got the VAT money to put down. So I'm a small business, I don't carry, and it's, let's say, use 30 grand as a round figure. I don't have the 6 grand in cash to pay out. So that's where you then start to explore a finance lease. You then look at something called a VAT deferral, which is something that you can do. Again, is that customer up to date with their HMRC payments to lend them the VAT over 3 months?
Right.
So if the customer doesn't have the VAT and doesn't qualify for a VAT deferral, then you end up at a finance lease. So the misconception of a finance lease is that I'll never own it. Now, the reality is you can still own it at the end. So what happens in the brokerage world is they have agreements with the lenders that the ownership comes back to the broker, and the broker then can sell that piece of equipment. Really, the sort of most common number is between 1 and 2 months additional payments. And at that point,
That's the option to purchase fee you'll often see on the...
No, so option to purchase fee is just on a hire purchase, which is normally anywhere between £10 and
That's like
£100.
an admin exercise sort of thing, yeah.
Yeah, absolutely, yeah. But on a finance lease, the trading agreements that brokers sign up to is that the equipment comes to them, or certainly the title of the equipment, not the actual equipment, and then they sell that as a third party to the customer. But that's only relevant on what we call soft assets. It's not on commercial vehicles or anything like that. Anything that's a true asset, like a truck, a trailer, a car. The finance lease, then the customer negotiates that with the lender to find a third party, which is normally an accountant. So the end of leases are slightly more complex. And
do you know why is that on a lease? It has to be a third party that deals with that transaction at the end.
It's because of any tax benefits that maybe have been accrued over that period.
Right. Okay.
Whether that's 3, 4, or 5 years. But a business owner that has a limited company that's not spending £1 million, it's under that £1 million threshold, should always look to a hire purchase. And I get customers that will talk to us and they'll say, what's the best products? I go, well, we're not tax advisors. I would encourage you to speak to your accountant, but the accountants will always say that hire purchases.
And what about, because there's also a lease, isn't there, an actual lease where it then does go back to, for example, if you got a new car on lease, it kind of goes back. So what's the difference between that, a lease, and a finance lease?
The lease in the car world is because there's some form of residual value or there's some form of security given by the supplier or the manufacturer, so that vehicle can come back subject to it being fully maintained in the main when you look at the car world. In the equipment world, they work on the basis that equipment has had its useful working life.
Yeah, so it's another one.
I don't want it back.
Yeah.
If you look at a 5-year-old set of 2-post lift, you think, I don't want that back.
Yeah.
It's worth something to the business as long as it's maintained.
So really, the only difference is between the hire purchase and finance lease is just the tool and the method in which that can be purchased from the upfront.
Yeah, and like I said, the reality is that ownership piece, and that's the key outcome. Do you want to own this equipment at the end? Yes, I do. Right, well, you've got to explore the HP as a primary.
And does the HP and finance lease carry the similar interest rates, or is there one that's right?
Yeah, exactly the same. Yeah, exactly the same. And anyone out there that says it doesn't is probably not the right people to be speaking to, because again, it's very easy to. There's a lot of smoke and mirrors in finance.
Yeah.
So just with that VAT deferral thing, then, because I've never heard of that. So if you go for a HP, you normally have to put a deposit down, and normally the VAT. Right?
Yeah, but that's a misconception. And when I got into the industry, it was HP must have a deposit and must have all the VAT up front. You can put just the VAT down. We're doing something at the minute. It's just VAT only. You can put one payment down plus all the VAT. The VAT's just how are we treating the VAT? And
well, the VAT's not worth anything, is it?
To the lender.
Yeah, exactly. So what you're saying is that this deferral, if the business doesn't have the cash in the bank right now, let's say they've just paid the VAT bill, you will defer that payment for 3 months. So in 3 months' time, they have to pay that VAT
so you
element.
claimed it before you pay it out.
You claim it, so the money comes in.
Yeah, so you're getting the money. Yeah. Okay, that's cool. Did you know that?
Yeah, but it's massive in the vehicle rental world, obviously, because you're buying lots of vans.
Of course, yeah.
But the downside of that is you're paying interest on
the
that.
3 months.
Is it just the 3 months?
Yeah, so in a sense, you're borrowing the VAT for 3 months.
Right,
so
okay.
It's slightly more expensive on your monthly payments, and it's just for that reason.
Right, so it doesn't affect the whole term of that deal. It's just that 3 months, right?
No, it does affect the whole term.
It affects the whole term. So you're borrowing the VAT for that 3 months, and that increased risk is spread across the term.
Right, yeah. Because I remember it adds quite a lot onto the overall interest you're paying that deal, doesn't it?
I suppose it depends on how much.
But for me, it always comes back down to the rationale, though, is that, well, don't borrow the VAT then. Well, I don't have the VAT. Well, then they're the options.
Or time it right with your VAT return. Like buy it on the 31st of March and get your VAT return in and...
Correct, and so then that probably comes full loop to the sort of planning undertones to this conversation. It's just about that planning piece. But we still do loads of finance leasing, loads of it, because customers like finance lease because it's no deposit. I'm paying me VAT. It's very low initial outlay. So when you look at an income-producing piece of equipment, I can get up and running really quickly.
I remember when we first started rental, we were using Close Brothers a lot, and we got to a point where we kind of like reached exposure from high purchase, but they would do as lease finance. Something. This is quite a few years ago, but
don't know why that would be. Yeah,
because the exposure's still there, isn't it? But
correct.
I think it might be down to they retain the V5. Sometimes they're registered to them, won't they? Then
depends on the product and lender, but yeah, I mean, and then the other products are working capital facilities, so business loans. Which
so that's actually my next question. So to summarise, if you can, HP. And asset finance, HP.
Yep.
Right. So outside of HP, outside of asset finance, let's talk about general business loans, like operating capital loans, loans to buy businesses, loans to buy goodwill, like everything that's not HP. What are the options available beyond a traditional bank loan?
Well, I think just finishing off on probably what can and can't be funded. So on a HP or a finance lease, we have funded full workshop fit-outs from pits to concrete in the floors and you name it, everything that you think can't be funded, we've
so
put in.
On that then,
training.
How can they possibly fund concrete in the ground? Because if there's one thing you're not going to get your value back on, it's a pit.
It's a risk-reward thing, isn't it?
Yeah, but it's all about the credit covenant. So is that balance sheet, is that business stack up enough to fund and take a view that we can fund 20 to 30% of intangibles. So again, you put an MOT bay in, there is some delivery, there is some install costs, there is build works.
It's not all metal, is it?
It's not all metal. So and lenders are pretty commercial. If you go to the right lenders, they're pretty commercial. They understand that you can't have the equipment without doing these other bits that are a bit intangible. But again, in the past, training, ongoing support and maintenance, there's different ways that we can structure that to make sure someone gets a peace of mind agreement for whatever's in there. But outside of that, there's been a huge sort of boom in fintech, business loan providers in the UK. And it's great in a lot of ways. It gives business owners, it sort of empowers them to go out there and see if they can get a facility. The problem then is that they've not maybe sometimes got the experience or the knowledge to am I going and getting a business loan from a funding circle or an iWalker, drawing that money down and using it to buy equipment when really I should be using asset finance to purchase equipment with. So
just on that point then, why? If it's and not just about price.
It's predominantly price and flexibility driven. So if a lot of the business loan providers that we work with, director's guarantee, for example, is on every single agreement. Whereas actually, if you built a balance sheet and you want to buy a 30 grand MLT, but I might not need a director's guarantee over here for an asset finance transaction. So there's sometimes a security, it's pricing.
See, I think security is a really important thing, isn't it? The great thing about asset finance is you're securing it against the asset. Whereas if you go and get a bank loan, it's either being secured against the mortgage or the property or a different asset, isn't it? And you've only got you've only got so much.
Yeah.
So if you can fund it against the asset, that leaves some potential room for those riskier loans, I guess.
And also getting a loan is, if you get a loan to buy an MOT bay, you're going to be paying for that loan probably 2 or 3 months before your bay's in and done. Whereas asset finance, you're paying for it when it's
installed and it's ready to go. But yeah, so having access to funding is fantastic. But what we see a lot of is the business owner going out there getting 30 grand from a funding circle, 30 grand from an iWalker, and all these other
what is
providers.
Funding Circle and what?
So Funding Circle is just a fintech challenger into the loan space, and they've got their place. So we have access to those lenders. The difference by going through a broker to access those lenders.
Are they a broker or a lender?
Lender.
They're an actual lender.
I don't think so. They used to use, so you could invest in Funding Circle. You could put 100 grand into Funding Circle yourself. Yeah, is it still?
No, I think there's some private funding houses in there now. But I remember when they first launched, and you used to get all the people that invested.
Yeah.
There were about 500 pages of John from
So
Barnstable put 50
if you
quid
borrowed
in.
100 grand, it could potentially come from 100 different people.
Yeah. When it first launched, I mean, it was
Quite clever concept.
But we've got access to them. I think the difference by going through a broker to access those lenders is what should be that correct journey. Yes, I can access you Funding Circle if you need it, but actually the right option for you, Mr. Customer, is this over here. So again, from a price point, whether you go to Funding Circle or you go through a broker, they charge the same rate.
Right.
Yeah.
So that's one of the things that
That one comes with advice and one's a form online.
Correct.
And would you normally get a better interest rate deal through asset finance versus a Funding Circle loan, or is it?
Yeah, but again, I go back to it. It's not. It's got its place.
Yeah.
It's got its place. All of these. I mean, we do working capital facilities from 3 months. So we'll do VAT funding for 3 months. That's got its place.
Yeah.
We do 5-year loans, but it's always about the right product for the right job and the right outcome. We've got merchant cash advance lenders where you can lend your money through your sort of merchant chip and pin terminal. We talked off mic, about the ups and downs of that, but it does have its place. But again, that's where the value from an intermediary, a broker, should come in, because they should
thought about this.
They should take you through that product journey to the right outcome.
So in order, then, let's say you've got a mortgage against the building that you're in, and you want lending on a ramp. It's HP Asset Finance.
Yep.
And then if you want cash flow injection, cash boost, it would be a secured loan with your bank against the mortgage.
That's
would
where
probably be the cheapest, but
Correct.
not very quick. Not very quick.
Because they'll lend up to.
And again, the other thing
It's more expensive though.
Yeah.
We've had secured loans and unsecured loans.
Yeah.
And the unsecured.
They'll always be slightly dearer because of the risk profile. But the other thing to consider here is time as well.
Yeah.
So if all of a sudden is that you want to go to the cheapest lender, which in the main would be your own bank if it's available, the decision making time on that could be 2 or 3 weeks. And if you've got something that's urgent, whether that's a positive or a negative, it's an opportunity to move quickly on something that could grow your business, or you're in a bit of a sticky spot. The time it takes. Yeah. So again, people have got to, business owners have got to sort of understand that the cheap money is available for the right businesses, but also if you're under the caution you need to move quickly, that's where an intermediary or broker comes into their own.
And that's where you've got to decide whether it's going to pay off.
Correct.
Essentially. So if a garage owner is looking to expand and they want to acquire another business, what options are available? Well, what position should they be in with their own cash? Yep. I'd be very surprised if anyone can afford to buy a business cash. Mm-hmm. Let's say the goodwill of the business is £250,000, quite a common number. What options do they have with lenders outside of their bank?
There's, again, I touched on it. There's a hell of a lot of finance brokers and commercial brokers out there, but it is a good place to start because they do give you access to whole market. People have approached us in our short life so far at One about buying a business, and they don't even know how that person's got to the valuation. So I think, it's amazing when someone comes in.
Often they don't, by the way.
And one of them...
the people valuing it don't even know.
Right.
Yeah.
One of them was a garage. I think the sale price was a couple of £100,000. The customer approached us, said they've got £50,000 in the bank. You ask, have you got a set of accounts for for the business that you're looking to buy. No, I've not got those yet. And then you think, well, why? How have they got to that valuation? So I think asking some really simple questions before you get to that point. How have you valued the business? Can I have a set of the accounts? And a lot of the time, the person buying the business is either someone like yourselves, where you've got a strategic roadmap, or it's someone who's worked in the business and the proprietor of that business is aging, wants to retire or whatever. So I think really getting to that base level of doing your homework, and these aren't really in-depth financial questions, but you've got to get to the logic of why is that business valued the way it is, get an insight into the accounts and the information, and then fundamentally I would always go through a broker in that instance, certainly for someone who's maybe a little bit wet behind the ears in terms of business and running a business.
Do you find that lenders are willing to lend on goodwill, or is it really difficult?
Have to be cash.
Yeah, I think that's a lender will look at the full makeup of a deal. That's the reality of it.
I guess the advantage of a broker might be that you can probably get 30 grand for an asset refinance, maybe. I know it's hard in industry, but still, it's the covenant thing, isn't it? It's more like they're kind of going, yes, we know it's probably not quite worth that, but based on the covenant, we'll do it as an asset refinance at 30 grand, a loan for 50 grand, and then so on. And
we've got an acquisition taking place at the minute. One of our customers is buying somebody else, and we've structured that deal. The business they're acquiring has the freehold property. They've got assets. We're refinancing those assets. We've put a bridge in on the property because his idea is, well, I don't need the property that's part of the deal, so I'm just going to flip that and sell it.
Yeah.
So we've raised money against the assets in the business. The people selling the business, it's a retirement sale. They're going to take their money out, the cash in the business. And because of the equity that's sat in the assets, we've been able to release a little bit of cash. So when that deal goes through,
there's an ejection.
Correct.
I think the downside for buying garages is there's often not the assets there to finance against. So unless you've got your own covenants to get some cash,
correct. And it's always about that. This particular deal didn't go through because we got right to the closing stages, and they said we don't have the deposit anymore. So then it sort of fell flat on its backside, and sort of wasted a bit of time. But again, it's always, has the people buying the business, if there's not a lot of goodwill sat in there, have they got their own war chest? Are they homeowners? Have they got that equity? And lenders look at equity. We touched on security before, but the highest form of security we take in the main, certainly in my 20 years, has never been any higher than a director's guarantee.
At what point do lenders want charges and things like that on business?
I've got to be honest, my experience into that world, a lot of it will be down to your bigger transactions, your business acquisitions. Where our business sits is sub 350 grand transactions,
and mainly asset,
and it's all asset driven. So again, directors' guarantees are quite common. The great thing that's become apparent over the past couple of years is a business that's brought out an insurance product, which is something that we offer now. The fact that people do sign directors' guarantees, I don't think they're very well articulated to the customer as to what they're actually signing. And then what we've got now is from a peace of mind perspective that people can sign directors' guarantees, but there's now insurance products out there to
protect them from it.
Protect them. Yeah, so it's something that we do on every, give people that option at every guarantee.
So it's essentially just a more expensive, riskier loan then, at that point. So people listening to this then, let's say they've got a reason to get finance then. What should they be looking for in a finance provider? Because as I go back to the start of this episode, it's one of those industries that's felt quite fickle. Apart from our bank, which we've got all of our mortgages with, we've kind of just flitted between whatever the best deal is. And that's broker or lender or whatever. What's your advice to people? You work in it, you live in it. What should they be looking for in a finance provider outside of the cheapest price or someone who says yes?
I think it's down to any business at that point. It's about service delivery and transparency.
So what does service delivery look like, though, you just...
So we I think before you go and approach a finance provider of any kind, it's thinking about what your key driver is. Is speed important? Is price important? What is fundamentally important, and being clear in that message to whoever you're speaking to. I think the lender and the broker has a responsibility to take you on a journey from a pricing point to manage expectations, to give you all the information that you ask for, and even if you don't ask for it, we should be pushing that forward as an industry. Again, commission disclosure has massively helped that, because now everything is off. Everything is available and accessible to a customer now. Take the time to read your documentation. I think that's a massive one.
Is there anything that people need to look out for? Any like sneaky bad practices?
Historically, there used to be something called minimum term. I touched on the subject before about an opportunity I came across where we'd funded some wheel alignment equipment, and the guy had done a 5-year deal with another finance company, and it had run into its minimum term, which basically means you have to give notice. He wasn't written to, and he paid an additional 4.5 years longer than he should have done. So there were some real horror stories. I do think, as an ambassador for our industry, I do think it's starting to move onto the right path now.
They still exist such a thing.
With some tier 3 lenders.
Oh, right.
But again, everything we do is fixed term. As a business, it allows for the business to plan accordingly, because the payments aren't going to go up or down. They are a fixed term agreement. So again, it's that level of transparency. A lot of our frequently asked questions really are what happens at the end. That's where people are really, they can't think that far ahead, 3 years, and they just want to protect themselves.
In the past or something.
Or they've been caught out in the past, yeah.
Just before we wrap up, because we have been going an hour, believe it or not, it goes pretty quick. Leo, question for you. You've recently bought that dealership, and it was a big transaction. How did you fund the goodwill aspect of that transaction?
Deferred payments and cash loan.
So you got, was it a secured or a non-secured?
Unsecured loan.
But director's guarantee.
Yeah.
So director's guarantee, non-secured loan.
Yeah.
And then you got payment terms with the people selling the business.
And some cash that we already had in the business.
And obviously your own cash, yeah, of course. Okay. So, I forgot to wrap up the previous question then. So people are looking to buy. Financing the goodwill is very difficult to do, isn't it?
Unless you've got the type of arrangement there where you said the business you acquired, where you can defer some of the payments.
But I think that's back to the point. If people are looking to sell their business, and if you think about the type of person who is selling a garage, they have probably never been through the journey of acquiring or selling a business.
Correct.
So their expectation from the offset might be, I want it up front.
Yeah. I think everyone's got to forget the whole goodwill thing, haven't you? Because when you're either financing something that exists that you can touch and see, or you're borrowing some cash.
Yeah.
Or you.
But I think it's a bit awkward, isn't it? In that you've gone to this person's business, they don't know you, and you are now asking them to lend you the money to buy the business.
Yeah.
But what are the options? You can't, like, the sort of person who's going to buy that business isn't going to have the cash in the bank, or shouldn't have the cash in the bank. They might do, but very, very rarely. They're not going to be able to get funding on it. So then this person who's selling the business, their options just constrict right down.
It's a massive thing in all businesses. On a business that's sold for millions of pounds, and there's always a deferred element, or there's an earn-out element. It might be that we'll pay you what you say you want, as long as within 12 months that it achieves what you're saying it should be achieving.
Yeah.
Right. It's a protection mechanism for the
There
buyer.
is a protection mechanism.
And also the seller can still have some security on that deferred payment. They can have a charge over the business, or they might have they could put a charge over your own business that you've got now.
That's right. So I actually had a phone call yesterday about this, and they were asking this, our second most recent acquisition, it was deferred payment, but it's guaranteed against the business. Now he's had to look at our business, and he's still
taking... Is that strong enough for me to take that risk?
Exactly. He's still taking a gamble.
And I think the one we just bought, they had a charge over the shares of the business that we bought.
So they can have it back.
Yeah, the risk of that is, would you want a business back that's...
in the ground?
Can't service the loan.
Yeah.
Sorry, I just wanted to wrap that point up before we finish, because I do think that lots of people do want to buy businesses. We're speaking to them all the time, Leo, and their options are very limited.
Well, there's lots of people who want to sell a business as well, isn't there?
Yeah.
And it's the same thing.
You've got to set your expectation.
And it tends to be, in your world, a retirement sale.
Yeah.
A lot of the time, the people selling the business.
Yeah.
I would say, all but one for us.
Baby boomers kind of time, isn't it? So
absolutely.
Yeah, and that's not just our. It's and they're saying that this year is a really good year for that, because you've got all these tax changes that come in. Obviously,
They're all scrambling to sell their business.
Yeah, also entrepreneurs relief's going up, isn't it? It's not actually it's not actually called entrepreneurs relief anymore, is it? It's called something asset disposal.
Yeah.
Or something
Yeah,
like that.
and that's at risk. That is.
It was going up, isn't it? A few percent soon in April.
Yeah, but it's not going to stop there, is it? I think that's the
starting point.
Whatever. Let's not get political. Yeah, I know there's a lot of information there in that episode. Yeah, thank you so much for coming down.
No,
I've learned a lot.
Yeah, I hope it's been of interest to some people. I'm not sure.
If you're still here listening.
See how engaged they still are at 1
hour.
hour and 13 seconds.
Yeah, exactly.
Yeah, absolutely. Thank you for the opportunity as well.
So you've made the effort to come down. People want to get in touch with you. What's the best way?
LinkedIn, we're pretty prolific. I've got a good online presence through LinkedIn. Reach out. I'm always of the belief that everything and everybody is worth a phone call and a conversation. So I'd always encourage people just to ring up.
What's your website?
www.onefunding.co.uk and reach out. But like I said, LinkedIn is where we built our presence from. And it's not the hard sell. It's about giving people the honest, straight, transparent advice. I think I said to you guys beforehand, when we launched this business, I thought we'd have to do something that really sort of put us above the parapet in terms of products. And we do the basics really, really well. And we're here to sort of be on people's journeys with them to growth and success, hopefully.
Yeah, and I've definitely got that feeling from you during this conversation. Yeah. Thank you. Thank you.
Thank you very
Okay.
much.
Right. Thank you
Cheers,
for
guys.
listening. We'll see you on the next one. Thank you.
Cheers,
Bye-bye.
bye.